Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Johnson & Johnson. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Now, on Tuesday's Stock Play of the Day, we talked about a long call in Johnson & Johnson. I'm highlighting the long call here inside the options playbook. Now, we went out further in time and we went deeper in the money, and we build this as a strategy where we're going to use the long call option as a substitute for owning the stock outright. And inside the options playbook, we actually have a section that focuses specifically on this strategy. It's inside the rookies corner, and it's titled Buying Leaps Calls as a Stock Substitute. Leaps is just a fancy term meaning longer term option contract. We went out to the September expiration and we bought an option contract that was quite a bit in the money and had a delta of around 80 cents. And we'll discuss that a little bit more, what that actually means. So let's see how the stock did since our Tuesday call. What I'm showing you right now is a 15-minute bar chart. We always tape the show live, so we're dealing with live markets when we talk on the Stock Play of the Day. So this was noon Eastern time on Tuesday. So for the rest of the day, Tuesday stock was fairly flat. When we entered our strategy, I guess we should highlight that the stock was at 168.80 approximately, right in that range. And then all day Wednesday, this would be the trading that happened. It ended up a little bit down. And then on Thursday, it had a spike down, but it didn't stay there for long. Traded all day Thursday, ended up relative to where we put the strategy on. And now here we see it trading at 170.58. So if we call that approximately 2 points that the stock has gone up since we talked about the strategy and we're on the show. So we build this as an alternative to buying the stock outright. So if I had bought 100 shares of Johnson & Johnson at 168, that would have cost me around $16,800. And if the stock went up 2 points, approximately 2 points, we would be up about $200. So let's go in and look at how our strategy has done. Here is the Ally Invest option chains, and we see Johnson & Johnson right now is up 56 cents at 170.51. The market is live. We went out to the September expiration, and the paper trade for that week, and they're always paper trades. We don't really mean these as recommendations because we're just trying to learn here on the Stock Play of the Day, is we bought the 150 strike call. The delta on that was about 80 cents. Now we see the delta at about 85 cents. And that's because it's dynamic. As we get deeper in the money, the delta will increase in value, approaching 1, but never going beyond 1, because you should never earn more from buying an option contract on a 1-point movement than you would if you actually just bought the underlying stock. So the maximum delta could get to would be 1. It's trading at 85 right now. When we placed the trade, the market was at 1960. So the midpoint, if we were able to get a midpoint fill, was $19.60. So we paid $1,960 as opposed to what we would have had to pay for 100 shares of stock. The market has gone up 2 points, and we see the midpoint of this at about, let's call it 21.50. So we're almost up $2 on our option contract, and so it succeeded in our goal. As a surrogate for owning the stock, we basically had the market go up, and we got almost as much in our strategy, in our long option contract, as we would have if we had bought the stock outright. So that achieved our goal. We also talked about, because we actually had someone ask about a fig leaf, which is also known as a leveraged covered call. And here's the fig leaf strategy inside the options playbook. We weren't billing that as the paper trade for that week, but somebody asked a question about it. So we looked at, well, if you wanted to, you could sell a shorter term option contract against it. So I'm going to go back to the option chains now. And what we talked about selling was the very short term. So whenever we're doing a fig leaf, first of all, you don't have as much capital involved in the overall trade. Now we're doing this as a surrogate for owning the stock. So basically, we're saying we had $16,800 in our account. We could have bought 100 shares, but instead we bought one contract because we wanted to get that representation, but we didn't want to have all the risk. And we limited our risk on the downside to what we paid for that option, which would have been that $1,960 because we paid $1,960 for it. And that would have been the maximum that we could have lost on the trade, but we're still getting some of that upside. Now, Johnson & Johnson is a very interesting choice. And as usual on the stock play of the day, we're trying to pick our strategy based off of the pricing on the option contracts. What's the value of the stock? Where is the volatility? Are they announcing their earnings? Are they not? What's going on in the marketplace? And that's part of the reason why we decided to buy this leap option contract overall. So the 175, when we talked about it on our show, was trading for about 23 cents. We see that we're up about a dime on it, but we're not in danger right now of getting the stock call or the stock called away, which in our case would be an option contract. And so we would just let this ride. If you did sell this call against it, if you did not, well, maybe you want to sell one now. The biggest thing to realize that if you do buy this option contract, I'm going to scroll back down to the leap option that we talked about. If you do buy this, you want to pay attention to the time premium. You are still buying an option contract. You're deep in the money. You have a lot of real value, otherwise known as intrinsic value, but you still are paying some time premium. So one of the things about selling a call shorter term against it is you're whittling away at that time premium. If I look at the value of the put, that's an out of the money put on the same strike line, it gives you an idea of the time value that you purchased. Right now it's showing about $1.80 at the midpoint, right? So you bought probably about that. It's it's not perfect math, but that's probably about the time value. So if we could bring in 23 cents and it expires, that whittles a little bit away, go out another 10 days and then just keep chipping away at it. So then you really don't have to worry about the time decay portion of the option strategy because we're whittling away. Now, also mention that you don't own the stock, you own the option. So if the market does get to your strike, you got to do something. You got to either roll that position out in time or you need to just close the position and move on. And that's just the way that I would approach it. So just have a plan in mind if the underlying stock got to your strike and you did have that short call option on it. But we went out to September because we wanted to be bullish more long term in the option space. It's why we picked an option contract. Right now, it's still got 126 days remaining to expiration. Don't plan on selling it anytime soon, but you should pick. You do have an option, so you should have a sell order in wherever you would like to sell this underlying stock at. If you were okay with selling it at 25, 30, feel free to put that limit order in and make it good till canceled so it just sits there. If it does get to that price, then you can get out. You can manage your risks to the downside too. We talked about that on Tuesday's show. So if for the official, I guess, overtime paper trade, we would just, if we were looking to close out the position, got a little bit of a profit. I'm not saying this is a recommendation at all. Just know that if you do have this position on, this is how you would close it. You'd say, I'm going to sell to close one contract, September 15th or September 17th expiration, 150 strike call. And let's just pick a number. Let's go 28. Make it good until canceled and click preview order. And that's how you would set up a long-term sell if the Johnson & Johnson option contract got to a price that you would like to sell at. That's it for this edition of the Stock Play of the Day Overtime. We'll be back this Tuesday for another Stock Play of the Day. Please click subscribe and ring the bell, and you'll get all the alerts for all the stock plays of the day. Thanks for coming, everyone.